Sunday Night Live! Sunday Night Live, let's trade! Sunday Night Live, let's trade! Welcome in. Lights up, we're rolling. Who's locked in and ready to go? From the open to the futures flowing. We're the crew that wants to know. Stocks on deck, who's watching? We are. Shots on fire, hearts are locked in. We are. Welcome to the Sunday Night Live trading show. When we say ho, you say let's go, let's go. Oh, let's go, let's go. Oh, let's go. Join us as we ride every wave, high and low. Huddle together, let's trade. Energies move tick by tick now. Metal shine, golden grid now. Hold it. Crypto swings wild and reckless. We don't think. We break it down, turn the stressless. Link by link. Welcome to the Sunday Night Live trading show. When we say ho, you say let's go, let's go. Oh, let's go, let's go. Oh, let's go. Join us as we ride every wave, high and low. Huddle together, let's trade. Oh, let's trade. Let's trade. Oh, let's trade. Who's in the huddle? We're in the huddle. Who's got a plan? We've got a plan. Who's trading smart now? We're trading smart now. All together, raise that hand. Welcome to the Sunday Night Live trading show. When we say huddle, you say let's go, let's go. Oh, let's go, let's go. Oh, let's go. From stocks to energies, metals, crypto flow. Huddle together, let's trade.
Oh, well, good evening, all. It's James here. Welcome to the Sunday Night Live show. As you can see, I'm in a different location once again. So just bear with me. I hope everything's good. I think we've set up some proper internet connection here. Back at home in my town, we have no electricity again for 2 weeks, and the sewage is flowing into the sea. Believe it or not, it's a catastrophe, and I've got out of town. So I'm in a different place. I'm back in Jeffreys Bay. Let's get into it. We're starting in a couple of minutes' time. So welcome to everyone here. I'm glad to have everyone. And make sure you can hear me well. And if you can't, if you can, put a comment up in the chat right now, and I'll adjust it. I've got a microphone sort of dangling across my face here, as you can see over here. So it should pick up okay. And we've got a proper camera today. Everything looks good. And good internet here in Jeffreys Bay in South Africa. Surf's cooking. I've got some drone footage video as well for you guys to have a look at. I'll show you tomorrow in tomorrow's video of the surf. So I'm having a great time. Anyway, it's Sunday and it's time for Sunday Night Live. And in 2 minutes time, we'll start. So shuffle in, make yourself at home, and welcome to everyone that's here. Say hello while you're in the chat. Say hello to everyone. Let us know that you can hear me and that you're all good. Okay, fantastic. Thank you, Emily Trading. Awesome. All right, folks. So what I'm going to do when we start in a minute's time is I'm going to go through some of the news that came out last week regarding economic data, stuff that's coming out of the Gulf in terms of the war, and all that stuff that's happening there. And we'll have a look at the effect on the markets. What economic news came out? There was some, and not all of it was very good. So there's lots to talk about. So I'm glad you can all hear me. Paul, it's nice to see you, mate. And Stan Fitz, you hear me well. Fantastic. All right, so I'm just going to literally wait for 1 more minute until everyone comes into the room. I don't want to start early so that no one misses anything. So once again, if you've got a question, put it up in the chat now, and I'll try and get to it towards the end of the chat, towards the end of the session. Let's have a sip of Red Bull and get into it. Yeah, I'm rather pleased to be out of town and in an area where there is actually electricity and there is no sewage flowing into the sea here, which is, pretty good news. It's the least one could expect, I suppose, but, we live in Africa. Anyway, I'm going to go across to the notes now and let's get started. and we'll get going right away. And we're going to start with Sunday Night Live, weekly cross-asset market report. I'm going to go through these notes very quickly, and then I'm going to go straight into the charts. I don't want to spend too much time on the notes. I think I've been spending too much time on the notes. So let's go through them a little bit quicker and read the main news. So number one, top economic data and macro developments in this past week or so. Some of the big ones. There have been lots of data and lots of, I think we've finally now caught up with the shutdown data. I think we've got everything now. It's all coming in, and we've caught up. And now we're seeing the real numbers after the sort of disruption. So non-farm payrolls, the major downside shock, and the number came in at minus 92,000 versus a positive expectation. We would expect normally about 150 to 200,000 jobs, maybe 250 a month in a healthy growth environment. And we've seen basically jobs just dropping off. And we've seen this number swinging downwards rather than upwards, with some negative and some pretty low numbers, but we're not getting to the 150 to 200 to 250 constantly every month. And we're now minus 92,000, massive drop. So pressure on jobs, and of course that's going to spook the Fed. Jobs pressure is one of the major influences on their deliberations regarding interest rates, and so this is going to be a positive in favor of lowering interest rates. Unemployment also rose to 4.5%, 4.4. Workplace participation fell, and wages are still stickily high at 3.8% growth. So the interpretation of this is that the labor market is cracked. It's not collapsed just yet. As I said, we're seeing this sort of jig-jaggy set of data coming through. Some months slightly positive, some negative. We had 1 or 2 good months, but generally it seems to be a right down at the bottom. And if you're looking at a trading chart, you would say, well, are we in accumulation or distribution? And I think probably we might be in distribution in labor. So in other words, we might see these numbers drop further. So the labor market is not collapsed just yet, but it's certainly cracked. And weak hiring and firm wages brings up that name again that I mentioned last time, stagflation. In other words, we're getting inflation, but low growth in wages and low growth in the economy. And that means the Fed is going to struggle to cut rates, of course. So it's not a soft landing, but we're getting structural deterioration starting to show. Now, the other big number that came in, retail sales, and we're seeing the consumer weakening as well. So the numbers pretty flat. The GDP, core GDP relevant, in other words, paired against GDP, we actually saw a negative number, and then prior revisions were lower. So not good on retail sales. And the interpretation of this is that consumer rolled over before jobs, and slowdown is broadening. All right. So, and also the other thing is the bond market reaction. I don't know if you watched we're going to have a look at this chart shortly. TLT and the Treasuries, bond markets, all going a bit weird. We're going to talk a little bit about that on the charts because I've got some notes I've written on the charts about that. And then global macro spillovers, the IMF warning, energy shock. Of course, we're going to talk a lot about energy and what's going on in the Gulf, the Arabian Gulf, and the Straits of Hormuz. Persian Gulf, some call it. I've just called it the Arabian Gulf, I just realized. Persian Gulf. Maybe that's a Freudian slip. Energy shock means higher inflation, lower growth, and emerging markets are going to struggle as well. Weaker currencies, we've seen stronger dollar and inflation rising. So global stagflation-like environment. It's a pretty strong word, stagflation. A lot of people say, we're in stagflation. Stagflation is, brings to mind stuff like what happened in the 70s, massive inflation and low economic growth. We've got a bit of both right now, but not massive either way. Right, M2 money supply is rising back to record levels, and this means that asset inflation is likely to occur in time. Once we get through all of this messy stuff, right, the war, jobs, prints not looking good, the Trump factor, tariffs always lurking in the background. If we can get through all of this relatively unscathed, we will be scathed, but relatively unscathed, we could maybe look forward to a period of growth. That's not a popular opinion, not a popular view. That's my view. And this, supports asset inflation, in other words, growth in assets, stocks, metals, Bitcoin, all those sorts of things, and reinforces fiat debasement narrative. So, basically currencies depreciating against assets. And those assets, once again, things like stocks, property, Bitcoin, gold, silver, precious metals, watches, and stuff like that. US Treasury buybacks We've seen quite a lot of that going on as well, and I'll talk about that in a little while. Now, let's talk about the geopolitics very quickly. We all know what's going on, so we don't need to go on about this too much. There's a lot of messy stuff going on in the Gulf, and it may or may not be resolved very quickly, or it may take a very long time. It could be a quick resolution or a very long one. It might not be resolved anytime soon. The way things are going with nuclear facilities now being struck on both sides, not critically. I don't think there's any radiation leak danger just yet, but that is in the back of everyone's mind. Right, let's go through the notes. It's not an all conflict. Of course, now we've even got nuclear involved and the talk of that. Straits of Hormuz. This is an incorrect use of the English language, by the way, straits, not straight. 20% of the global oil flow goes through there, and it's already constrained. And oil infrastructure has been repeatedly hit, and so is LNG infrastructure repeatedly hit on both sides. And the energy is described as the worst disruption in history. Well, if this is the worst disruption in history, we haven't seen quite such a violent reaction as we might have expected. Natural gas hasn't done much, and oil did get to over $100 a barrel, but that seems to have stopped there for now. Now, this weekend, I don't know what's going on exactly in the Persian Gulf and in the Straits of Hormuz and on Karg Island and around that region with the infrastructure, nuclear and energy infrastructure that's now all under big threat. So it's a system level shock. And so oil is up 50%. Brent crude took the worst strike, of course, being mainly European and British. And then extreme scenarios, New York Post posting $150 to $180 a barrel is a possibility. I'm not counting that out. We're short on crude oil, but we will flip and switch back to long if we have to. Right, now let's go along. Escalation timeline this week. I don't think we need to talk about that too much. Are we going to be sending troops? I don't know. I mean, this seems like a very, very bad situation once troops get involved. There's a lot of hype on both sides. You know, the Trump administration defending all of this, and the liberals and the Democrats condemning it loudly, not only them, but also internationally. So it's just a real mess. And there's no coherent strategy. It means, I'm not saying that we don't have a coherent strategy, or Trump doesn't, but it seems to be that the way it looks right now. So second order effects, just remember all of this. Fertilizer prices are up 30%, 40%. Food supply risks are emerging. The costs going into food and supply of food, and shipping and insurance costs are surging, and governments are implementing energy restrictions, including potentially here in South Africa and other countries, even in the UK. So this is spreading from inflation, from energy to inflation to food to global growth. Now, let's quickly go through this, but I'd rather focus on this on the charts when we get there. And my voice is a little hoarse, so let me have a sip of Red Bull. And before we go into that, I'm just going to quickly go back to my notes to the chat and see what's going on. All right, so the sound's good. Okay, that's wonderful. It's going to be a hard week, that's for sure, Emil. All right, everyone's here. Lots of chat. Wonderful. Tesla. All right, we'll get to some of those questions. Thank you very much for all of those. I'll try and address those as we get to the end. All right, back to the notes. Now, cross-asset market implications. Now, what's going to happen with stocks? The broad market is showing weak data, bearish for stocks. All right, we just talked about the data. War and inflation, bearish for stocks in the short term, but in the long term, normally stocks recover and actually end up more positive after war because there's a liquidity injection, not just from the war, but we're also seeing M2 money supply increasing and buybacks of treasuries by the US. So all of that short-term pain, I think, but perhaps a longer-term prettier picture. And the net result is so far rotation, not collapse, although we've got very close to our critical breakdown levels on both the NASDAQ and the S&P, forcing me to hedge on Friday, which I really didn't want to do. And we bounced late on Friday after the options triple witching expired and all the markets bounced. So I'm now hedged on NASDAQ and S&P and on the German 30 right at the bottom. And we bounced at the last second on Friday. So I'm stuck in a short hedge. I've got long positions and now stuck in a short hedge. They're quite far apart. So we're going to have to work out how to do that this week. And probably I'll just take the hedge positions off. If we bounce here, I'll just take the shorts off and take a loss on those shorts and then add to the long side to recover the loss on the shorts. In other words, switch from now neutral. I'm hedged. I was long. I've now switched to neutral And hopefully now at this point, the markets will carry on going down and allow me to profit from my short hedges. But if they move up from here, I might have to take a loss on the short side, on the short hedges. All right, we'll come to that shortly. Now, the winners are likely to be, stock name winners, likely to be defense, energy, of course, and AI infrastructure, AI capex driven, all of that sort of stuff ongoing. So we're long on most of the AI stuff. No energy longs actually in the stocks, and defense stocks, we have one or two names on defense stocks. The losers are going to be consumer discretionary, weak retail. We've seen that already crept straight right in there, right? Didn't give us a chance, already dropping down dramatically, retail sales, and then rate sensitive growth, risk assets, basically. If yields rise or if interest rates rise, there was even talk last week about the Fed increasing interest rates in the light of what's going on with the war, inflation not coming down. We saw a CPI number of around about, I think it ticked up slightly. PPI ticked up slightly. So inflation seems to be growing, perhaps as a result of war, expenditure in war, massive expenditure going on. Just devaluation of currencies, printing of money, M2 money supply increasing, and treasury buybacks, all increasing inflation. And of course, that puts the markers on the Fed. But having said all that, oil is the main story right now, of course. It's the macro hinge. And if we get this stuff sorted out, we could see quite a growth in, big growth spurt in the markets. Oil is now more important than CPI. Of course, we'll all be looking at the oil charts and the natural gas charts as well. Don't forget nat gas, although it didn't react much, and although there were facilities struck in the nat gas fields in I was going to say Arabian Gulf again, in the Persian Gulf, although there were gas facilities struck on both sides there, natural gas facilities, didn't do much, right? And most of this pricing is in the US, but we did see increases in the price in Europe and the UK. Unlike oil, natural gas is driven by weather, storage, and positioning. And the war impact is secondary. We've seen LNG, natural gas, the price of natural gas on the futures, rising and falling in sync with the oil price. Normally, they're actually inversely correlated, but at the moment, they're pretty well correlated. So it's an energy shock affecting all energy, except for uranium. And our uranium positions actually went down rather than up. But natural gas faffed around, but oil massively up. So the setup for natural gas is that we've got a bear flag breakdown still. Speculative shorts are building. We looked at the COT report last week, showing that we're getting a buildup on the short side, but we're seeing that the commercials and the producers are swinging more and more to the long side. And there's a groundswell of underpinning, a groundswell of bidding underpinning this market, even though the speculators are convinced it's going down. I'm long on natural gas, but it may go down. I don't know. We'll have a look at the charts once again. So setup is bearish in the short term, but if there's a short squeeze, if the weather flips, if all the fields in the Persian Gulf get destroyed or blown up, or if LNG tankers get blown up, or if there's some other deal that goes wrong with shipping and the concessions that Iran has made for other countries apart from the US, if that goes wrong, all of these could cause this short squeeze, and weather, of course. Now, gold's caught is not dissimilar to oil and natural gas, caught between war, inflation, and fiat debasement. So we've seen a massive rally in gold. Gold fell off dramatically on Friday, so did silver. And we'll look at the levels. I think it's still got a bid under it, and I think it's still a bullish market. But we've got war, which tends to push the price up. We've got inflation, which would tend to push the price down, as the Fed would be likely to raise interest rates. And as gold has no yield, that's a direct onslaught onto gold. And then, of course, fiat debasement. As currencies drop, the price of all assets, including gold, goes up. But we've got rising real yields and a strong US dollar. The dollar is strong because it's a risk play. People, and not obviously, would be inclined to dump their euros or their maybe even Swiss francs and British pounds and buy dollars. The America's a long way away from the Middle East, and it's got a stable supply of everything in the energy business, at least, mostly stable. And the dollar remains strong in these instances. Don't bark. I've got the dogs behind me in this holiday house, both of them. Bobby is here and Harley. Bobby and Harley behind me on the bed. They're having a holiday with me too. I might introduce them to you just now and say hello. All right, so that's gold. So we've had a post blow-off reset, and we now need to base and make higher lows, as simple as that. So when we start seeing higher lows on gold and a base forming, we'll get more and more long. It's as simple as that. I think gold's got a very good chance of moving higher, as has silver. Silver's not only got a bid under it because of precious metal demand, but also it's a very useful metal. Just looking at these chats here, everyone's okay, just making sure everyone's fine. I've got different computers here in this holiday house, so it's difficult to see everything, but I'm doing okay. So silver, so silver's not only a precious metal, and it's run up with gold and platinum and all the rest of them, but it also has some use, and it's a pretty useful metal, all sorts of uses. And so it might actually do a bit better than gold. And during the last run up, silver actually got going first and gold followed. And at some points, even in the last year, I think, we were long silver and short gold. In fact, about 7 times. And every single one of those times, we made profit on the long silver and profit on the short gold. Right now, they've been moving together, but they will tend to start to deviate a little bit once the excitement's over from these big rallies and the risk environment that we walked into with this war. All right, we have bigger ranges, more volatility, and it's more sensitive because it's not just a precious metal. So I don't know, we'll look at gold and silver in the same sort of way, same sort of manner, looking for dips to buy into. I'm already long on gold, I'm hedged on silver, and I'm hedged on copper. We'll go to the charts very shortly. I'm going to try and finish up in the next 4 minutes. And then Bitcoin and crypto, it was doing okay last week, pretty well, and holding quite well. And on this weekend in low liquidity and after hours, and whilst the rest of the markets are now closed, Bitcoin has been moving down. Not dramatically, but dribbling down over the weekend. Never a good sign. And I suspect that means that there are things going on, not just Bitcoin stuff, but there may be other stuff going on in the background in the Gulf that has an effect on all this. So I think Bitcoin might be the only thing that we can look at on the weekend, unless you have access to your broker's data, if your broker allows after hours trading. But if you don't have that, Bitcoin's the only thing we can look at to determine what's going on in the world in the moment. And while I'm talking to you and switching across to my Bitcoin chart, Saturday, we dropped about from the high, just about 71,000, we dropped down to 68.5. So, quite a big drop on Saturday. Today's dropped a little bit further, but holding stable. So was doing pretty well, actually better than most of the risk assets last week. But this weekend, drooping off a bit. And I think that's, obviously related to this war. And maybe, just maybe, Bitcoin's got a really good chance holding up much better than the other ones. If this weekend, we're able to hold this weekend, and who knows what's going to happen in the Gulf. Anything awful could happen at any moment. So all of this is contingent on, what goes on there. But Bitcoin did really, really, really well in this last 2 weeks compared to other risk assets, held up well, actually rallied slightly, a slight rally, actually ended up stronger over the last 2 weeks than we were. The other risk assets did not, including gold, silver, and the stock markets. So Bitcoin did pretty well. Now the dollar rallied. We'll talk about the dollar when we get to the chart. It always does when there's war and risk on sort of environments. And then the final sense of this week's not about one story. It's a collision. And that's a good way of putting it. I thought when I wrote this, it's a collision, a massive collision. So we've got weak growth signals in jobs and in retail. We've got strong inflation risks because of oil and war and PPI being ticking up. And don't forget tariffs. Tariffs has had a direct effect on the price of goods. And although Jerome Powell played it down, when he spoke at the last Fed meeting, FOMC meeting, he said, well, probably a one-off sort of thing. I don't know about that. I think these are unknowns, really. And we can look at what happened before with tariffs and so on. But, the tariff inflation addition is probably there as well. And I don't know exactly what the effect is. I think Jerome's played it down a bit. But anyway, all of that. And then rising liquidity. So we've got weak growth, strong inflation, which is negative for the markets overall, but rising liquidity, M2, and debt management. And so that means that we don't have a crash on our hands. It's not clean. The markets have moved down, but it's a high volatility repricing environment. having said all that, let's go to the charts and see what the charts are telling us. And let's get straight in, and I'll switch across. Stop screen. Give me 1 second. All right. And seeing as we've just finished talking about Bitcoin, let's quickly have a look at what's going on in the Bitcoin chart and go straight into that. Now, this is Bitcoin. As I was saying to you, I'm not going to spend a lot of time on Bitcoin because I really just think that, there's just so much noise around Bitcoin and crypto, so many bad opinions, so many different opinions, so many opinions in general. And all of that has just, all of this noise that's been going on since we dropped to 60,000. And that was in February. We're now at the end of March and we've done absolutely nothing, just moved literally straight across the page, held support, bounced out, and we're now looking for support again. We came down almost to the 50% retracement level here, but this is the day chart. We're below the 20 period now. We're below the 50 period. This is what happened on the weekend. This is Friday's candle right here. Well, I did point this out on Friday as well in the video on Friday. I'll link that at the end of this one. But look at the volume over the last week or so on Bitcoin. This is the day chart. As we've dropped down, and even on that little sort of bounce there, the one green day in the last week or so, white candle, almost no volume. And of course, we don't have volume over the weekend. But dropping down in volume as we move down might not be a bad sign, actually. As we move down with low volume, maybe we'll move up with high volume and bounce out of there and get aggressive. However, not even on the green days, we didn't even get any volume either. And in fact, if you look all the way back to the beginning of March, that one big candle that took us out of the lower range, that was the only day that had a decent amount of volume. Not even that decent, by the way. And since then, volume has just been dropping off, showing no inclination for this market to do much at the moment. We need a catalyst. We need something to spark this off one way or the other. If it's going to move down, I will hedge all my positions. I've got a lot of hedge positions already. I'm mainly long from around 90,000, fully hedged at about 85 to 89,000. So just under my long positions. So I've got a lot of profit on those shorts, but I've got, I'm holding the longs too. And we've just started to buy some more down here in this, what I thought was a bull flag, turned out to be one. Beautiful. We've traded in the bull flag. And people are saying, well, it's at the bottom of a move. How can it be a bull flag? Bull flags take place, you move up a bit and then flag down and then move up equal to the first move. So we get move A, which is 100, let's say, a flag, and move B, which is normally 100 as well. So it's equal to A. C is equal to A. So that's what you would think from a flag. And that normally happens after we've got a good move. And we didn't even get a start. This flag happened at the bottom of a move. But we did move up from the bottom. Didn't happen precisely at the bottom, as you can see. And it's over here now. So it is a bull flag, even though it doesn't look like it, I promise you. And we bounced out of it quite beautifully. There's my phone. Excuse-moi. That's my alarm for the session to start. It's still set to daylight savings. So so that's where we broke out of the flag. We got going up quite strongly, quite nicely with that big green candle on the volume. We came back, tested the top of the flag, perfect, and the 20-day moving average. We moved up and we basically got above the 50 and the 20, these two lines, and got going out of the flag quite nicely. And then over the last week, we started dribbling down as this war became more and more complex. Now, if this war, which is one of the most horrific things that you can imagine that's going on right now in terms of the impact on the financial world, if this has not managed to completely destroy Bitcoin, when Bitcoin has been completely destroyed by much less things in the past, loads of times, all of the Bitcoin crashes that we see triggered or sparked by some, financial catastrophe, have all been way, way smaller events than this massive missile war going on in the Persian Gulf. And Bitcoin has actually weathered it incredibly well. So my base case remains bullish on Bitcoin. I don't know what's going to happen next. Don't ask me anything about this chart, apart from the fact that I think we've formed a bull flag, we bounced out of it, retested it from the top, bounced out again, and now we've dropped back down below the two key short-term moving averages. Not good, but there's a good story here and there's a bad story. The good story is the bounce, the retest, and the new bounce. And the bad story is this last week with what's going on in, in the Persian Gulf has driven this back down again, but not nearly as bad as some of the other stuff that we've looked at, including stocks and gold and silver and some other things. So I don't think I want to spend too much time on the Bitcoin chart, just to say, and I'm not going to talk about the other cryptos as well. I've got longs on Ethereum, XRP, and Solana, and nothing really much on any of the minor altcoins. I basically got a few in a wallet somewhere, and I don't really care about them, small amounts. But my main trades, my main play is Bitcoin, followed by Ethereum, and then XRP and Solana. And I don't know, I think we might do okay. Notice that Ethereum is holding the two short-term moving averages, 20 and 50. XRP has dropped down through them just today, and Solana is still holding those moving averages. So it's just XRP, and you could say Bitcoin's just about trying to hold. And by the time today closes, we might be above it again. We have not closed below the 50 here on Bitcoin or on Ethereum. We have on XRP, but not on Solana. So there we go. Now, folks, I'm going to quickly look at this chart. I'm not going to talk about stock names. All of these names will be dependent on the way the market works, where the market moves. The NASDAQ and the S&P and all the things that we've been talking about. But let's start with the dollar. And I'm going to switch from here. As soon as we finish with the dollar, I'm going to have a quick look at stocks. And then we'll go straight on to energies, including oil and natural gas. And then I want to look a little bit at a couple of other smaller things after that. So we'll do the major things first. But let's have a look at the dollar. What did the dollar do? As I said to you, the dollar tends to rally in times of uncertainty or taking risk off other currencies or assets or whatever it might be. And the dollar is the place in terms of currencies where that money tends to flow. With this war, and basically the bottom of the dollar was on the 30th of January. So we got February and March covering most of the duration of this new missile war from around about, I think, the middle of February to where we are now. I think it's about, is it 2 weeks or 4 weeks? I can't remember. But nevertheless, the dollar has moved up and all the way up to this purple line resistance level, and it's now rejected. I had this path drawn in here a very long time ago, and we got there a little late, right? But I think we could still do that. And I think we're going to move down below the support level, down to the 78.6% Fibonacci retracement right down here. And I think we could even get lower. That's down at around about 90, 95. But I think we could get to 92 or even maybe even into 88, slightly below here, before we see a slight recovery in the dollar. So yeah, so that's it. But for now, React don't predict. But for now, and I'm short on this trade. I'm not trading the euro or the pound or the CAD or the Swiss franc or the Aussie dollar or any of the other stuff. I'm trading the dollar index directly at Pepperstone, just because currencies are very messy. And in these times of war, uncertainty, and when the market starts swinging and we see currency debasement and asset appreciation, these currencies are vying against each other for dominance in a market where currencies are getting dumped in favor of other stuff, and even digital currencies. And so it's a fight against currencies between them and also overall against the market. I'm trying to play the overall play here, the dollar against everything else, not the euro against the dollar or the dollar against the Swiss franc or the Aussie dollar against the Canadian dollar. I want to trade the US dollar against everything else. In other words, everything else, literally, like all assets. And so I'm now short on the dollar. I expected it might have to get up here once the war started, and it did. And we faffed around here. Look at this thrashing around at the top here. Big bullish candle, shoved down twice, massive bullish candle, massive bearish candle, recovered on Friday, bouncing back up again as the stock market started to recover as well. And look at this top here. 1, 2, 3, 4, 5 tops. Don't often see that. And more likely than not, if you get 5 tops, 5 attempts at a particular resistance level, the market's more likely to break out through the top, not through the bottom. And so this could happen in this case as well. Look at the RSI, it's overbought, well overbought. We're moving down. And Friday's candle, or Thursday's candle at least, was a massive bearish engulfing candle. But we've seen many of them before in this very choppy and messy market, whipsaw deluxe. Anyway, I'm going to stick with the shorts. I did get hedged over here. So we've got a bit of a hedge there. I'll unwind that if we get back down there. And then I'll probably try and get short again tonight or tomorrow, depending on how this market opens up. And it all depends on what goes on in the Straits. So I'm not going to rush into buying or selling the dollar either, because just like everything else, this is going to be bashed around by missile strikes, basically. So I'm short the dollar. We're at this, 5-way top. I expect it to move down. Let's quickly do it again before we move off. And I expect it to move down into the 78.6% retracement of the entire move up in this massive rally that took place after COVID as the dollar appreciated against all the other currencies. And we've moved down, formed what looks like a bear flag, fake out through the top, and now we've broken the bottom. That purple line, if you remember, if you've been watching me for a few years, that purple line, we've been watching this for about 3 or 4 years. I've called it Dixie Moab, the mother of all breaks. And I said the moment we broke down through that line there, we would tend to be lower on the dollar and, in fact, probe even lower than we currently are at. And I also said that once we break down through Dixie Moab, it's likely that we'll retest it from the underside multiple times. Look how many times we tested it from the top side. Once, twice, 3 times, 4 times, 5 times. Look how many times we've tested it from the bottom side. Once, twice, 3 times, 4 times, 5 times. And so look what happened on the next attempt we broke down. So are we going to break up? I don't think so. I don't know. I think Dixie Moab's going to hold. We could look at this on the weekly chart. Moab meaning mother of all breaks, not related to what's going on in Iran right now. And there it is there. Look at that beautiful level, Dixie Moab. It's perfect. That's the dividing line at roughly 100, which is parity for the dollar, right? When the dollar index is at 100, it's at parity. And so the dollar tends to flip-flop either side of 100. We've been above it for a long time. We were below it for a long time. We've been above it for a long time. Actually, I'll tell you how long we were below it. We were below from early 17 to 22. So call that 5 years. And then we were from 22 until 25, 3 years, we were above the line. And now we're below it. I expect we will be below the line for 3 to 5 years. And that means we'll be trading in this lower range, and maybe we'll get even lower down to that blob, and maybe we'll even get back down to the bottom of the range at about 88, or 89. So all of these possibilities are all these probes down are possible. We've just got to hold this level here. It's really key, really crucial. You'll see now that that purple line is really, really, really key to the dollar. And if we do manage to break above that line and hold above it, that will not be good. I'm going to make this super thick there, that line there, big black line. So if we manage to break above there and hold above it, it means the dollar's going up and many other assets might go down. And that might actually be the way this market's about to unfold. I don't think so. My opinion is that it's going to move down and that the rest of the market, other assets are going to move up. Exactly the opposite of what I just postulated earlier. So that's why this chart is so incredibly important for all of your deliberations. And that's the reason I'm trading this chart and not trading the euro, the pound, the CAD, the Aussie, the Swiss, all those, as I have done for 30 years, but I'm trading the dollar against everything else. And I think that's the critical distinction. Right, let's move on from the dollar. And we've talked about Bitcoin. Let's look at stocks. Don't want to spend too much time. I'm not going to talk about stock names. You trade your own stock names. Pick the ones that you like within the sectors that you like and trade those. Don't worry about the names that I'm trading. We'll retrade those in the private group. But I do want to, for the purposes of these videos, talk about the NASDAQ and the S&P just quickly. You can see where I hedged on the NASDAQ. We broke down through that level there, that one right to the left-hand side, got a slightly lower than that. We broke down through that level there, over there too, and I hedged the position. Simple as that. Now, late on Friday, once triple witching was dealt with, we bounced out and left my hedge behind in a loss. And we've got, lots of long positions. Those are looking better, but the hedge position is now negative. And we got short right at the bottom of the move, having broken slightly down. I hedged it on the small retrace back up to that level, and I'm now fully hedged. Same on the S&P, and the S&P did something just as evil and tantalizingly wicked, and broke down through my invalidation zone quite considerably. Actually, that's no small spike, and we smashed down through it. And the moment we did that, I got hedged. And so I'm hedged on the NASDAQ, hedged on the S&P, and my long positions start from just above here around the 200-period moving average. That means that I've got to now unwind. If we bounce out of here, I've got to get rid of the shorts, right? Maybe we'll retest the bottom and bounce out tomorrow in the market session. Maybe we won't. Maybe we'll just bounce straight out of here and go gangbusters up. I don't think so though, because this war is still so uncertain and so messy that there's not going to be a lot of interest in, I don't think anyway, massive buying of stocks. And we did break the support level. We broke it convincingly, even though we bounced out, forcing me to hedge. And so I don't know how many other people are hedged down there, but if it is a bear trap, and it probably is the way it looks, it's trapped an awful lot of people because this was triple witching, options witching on Friday, and loads and loads of people have been short. The market is heavily short. The fear and greed index is basically at zero. Not quite, I'm exaggerating, but it's right down in extreme fear. Everyone is short. All the retailers are short. Many hedge funds are short. I was long, but I'm now hedged, which means I have short positions. And many will have been shortened. Many would have been trapped with the shorts there, like I was. And if this bounces out, I'm gonna have to take a bit of pain. Just really take those positions off and let the longs run up, and maybe add some more to that and take a short-term loss. But if this keeps moving down, we've got a few things we could reach. The trend line down there, for example, that's a very beautiful trend line, even though it was damaged a bit by the tariff sell-off and the Zweig breadth thrust out of there. So that's another target, the trend line. We could get down here to the origin of this breadth thrust, which broke out of the double top. This was the tariff sell-off. There was the double top, which actually forewarned it. Isn't that interesting? The tariff sell-off, no one knew that was going to happen, but the market told us that was going to happen about 3-4 weeks before that, with a little double top over there, and started to move down before that. Anyway, just interesting. We bounced out of there, broke through the double top, didn't quite retest it from the top side, interestingly. We haven't done that yet. And maybe now we've got to retest that breakout from the top and come all the way back down to 6150 or something like that before we try and get bouncing again. Probably quite likely, folks. And I would welcome that, because I'm now short and hedged. In other words, I've got longs, but I've now got shorts on. And that'll give me the opportunity, if it moves down, to not have to take a loss on my hedge and to get profit on those short positions at the orange arrow, take profit on those shorts. There's the lower 200 period Bollinger Band, point of control on the chart. Great target, by the way. And you know, my favorite target. And if we do get down there, I can take profit on the shorts, see if it turns around. If it doesn't, I will just re-hedge the whole lot. But if it does turn around, I can start to add some more long positions on to shore up some of these positions. They're not very big. I don't have massive positions on here at the moment, but I would like to get longer if I can, either on a bounce out of here, which may happen, or if we have to get down to the trend line and bounce out of there, that could happen, or if we've got to get down to the double top breakout level after the Zweig breadth thrust, we could get back down there, and that's at 6150. All of those are possibilities. My least favorite possibility now is a bounce out of here, leaving my hedge position, short position behind, and forcing me to have to remove that at a loss. That would be unpleasant, but necessary. So that's the way it is. And I was talking about the S&P, exactly the same thing goes to the NASDAQ. And then all the stock names is too much to talk about. NASDAQ did exactly the same thing. And if it does break down, I've got a target down below. There's the double top on the NASDAQ. There's the Zweig breadth thrust out of the tariff sell-off. That's the target if we get lower. There's the lower 200 Bollinger Band. And there's my blob, which I've had drawn in there for about 2 months now. So, or maybe 3 months. So there's my blob. That's the target for the NASDAQ. Now, I'm preferring these markets to move down, to be frank. I want the NASDAQ to move down to there so I can take profit on the short side. And I'd like the S&P to move down to either the trend line or that similar double top breakout and the low 200 period Bollinger Band so I can take profit there and then swing to the long side. If we bounce out of here right now, tomorrow, tonight, that'll be my least favorite scenario. It will mean I've got to take a loss on those shorts. Right, now, gold and silver. And the next thing I'll talk about is natural gas and oil. We've got another 15 minutes left, so we're doing okay with time. Now, gold, right, this is a tricky one, right? I got long on gold over here, and we've dropped down to here. This is a 10% position, and very small. We've dropped down to here. I think we could get further now. Basically, on gold, I'm looking to buy the next proper dip. This is the day chart, right? So it's very bearish at the moment. I'm going to have to hedge if we don't bounce out of here tomorrow. If the dollar reverses tonight or tomorrow, the dollar will have a major effect on gold, because gold will struggle to find footing and bounce out of here with a lot of vigor. If the dollar remains super strong and even gets stronger, it will put pressure on gold. Gold has no yield. And so people will rather buy dollars than gold or anything else. And, if they think that gold's not going to rocket up anytime soon, it's not a good place to park your money, because you get nothing for it apart from the growth on the asset. And so, if the dollar's offering more, if other things like Nvidia or whatever, Bitcoin is offering more, you could see gold selling off and Bitcoin, for example, rallying. There's an interesting chart that I've got on here, the Bitcoin gold chart, as we're talking about it. And the Bitcoin gold chart has bounced out of this reversal pattern with an inverse hammer on the weekly, followed by a bullish candle, gapping up with a massive bullish candle last week. Remember, Bitcoin was the only thing that actually did pretty well, not brilliantly, but pretty well last week compared to everything else, and even very, very well against gold. I've got a little arrow there, and I think we could get up to the top of that gap. That's a little gap, and the top of that gap's at about 17.91. We're now currently trading at 15.7. So that's about $4 up from here. It's about 20% higher on Bitcoin v gold. And if gold does not drop and this chart keeps on moving up, it means that Bitcoin will move up against the US dollar. Pretty simple mathematics. So that's Bitcoin v gold. And I don't know why we're talking about it. I do know why, because we're talking about gold. So gold has dropped down. Bitcoin has held firm, actually rallied last week while gold was moving down. Gold looks terribly bearish. This is a shaven bottom candle. We did have a bounce off the 100-period moving average the day before. That was Thursday. Looked okay. Looked like we were going to do all right. We've now made a slightly lower low, and we've got all the support down below us. I have a feeling that gold could get, and I might have to hedge it if it keeps moving down, that gold could get down to this level here. I think that's the most juicy and tempting area for gold. And it's basically just perfect, right? It's a confluence of all sorts of things right here. Not only the trend line, the 200-day moving average, this horizontal line at the breakout level. It's also a Fibonacci retracement level. And it's just a decent, wholesome area to buy gold if it doesn't manage to hold where we are currently trading. That level there is at precisely, and it might actually take a little time to get there. It might not go there immediately, as you can see. We might have to get into the apex of that. Where's the trend? Where's the arrow path? We might have to get into the apex of, so instead of going straight down there, we probably have to get across a little bit and then out. So it's not going to be immediate. And that means we might have to zigzag down into there, maybe with a descending triangle, an ascending triangle, falling wedge, an accumulation zone, a one up, one down on the daily or weekly spike low. So faffing around, basically, that's what I'm trying to say, faffing around in this area until we get into the apex of the 200-period, the red trend line, the horizontal here. Notice that we're at the top of this other support line. I should draw a line across there, actually, because we might just hold here. And as I said, it's not a foregone conclusion that we've got to go lower. And the top of that swing high, more or less in the center of your page, this one over here, is, okay, we haven't even got there yet. But notice, it's the bottom of this spike low. It's the top of that swing high, and it's just below us. So we could try and bounce out of there. But I think that level in the blob is going to be too tempting because we've got so much going on here and so many juicy targets that I think that's more likely. That would take us down to 4250 roughly, actually 4220 on the dollar, on gold versus the US dollar, 4220. And if that moves down and the Bitcoin gold chart moves up, as it is doing already, we could see Bitcoin doing okay. So that's my plan for gold, unless we bounce out of, let's put a small blob where we are currently trading. So I'm going to give you two options, a baby blob and a papa blob. So baby blob there and papa blob just slightly below. And can we bounce out of here? Maybe we can, I don't know. It doesn't look like it. It's very steep, very sharp. It looks, maybe it's a price magnet move and it's just been super attracted to the area and it'll smash out of there. Certainly didn't do that on Friday though. Closed with a shaven bottom, no wick. And it looks more likely that we'll get down to 4220. That's gold. And silver, I'm fully hedged on. I'm expecting a similar thing. And you know this path already because we've talked about this many times. I drew this path in a long time ago. In fact, when we dropped down here, I had this path drawn in already. And I thought we would have completed all of this nonsense by then. We have not. And so I've now just drawn further along. There's the 200 period. Remember we talked about the 200 period on gold and the horizontal breakout level on gold. Well, there's a similar one on silver. Right down here, maybe just allow for a little poke through just to fake some people out. Right there. So that's silver. And now I'm fully hedged. I've got a long from there and hedged over here. So a real mess, actually. I haven't traded this well, but I'm not surprised. Not many people will have. we've got a big breakout triangle here in the middle of the screen, and that will represent a big retracement for silver, all the way down from $110 all the way down back to 55 bucks. That's a massive pullback. And gold didn't do anything like that. If we had to retrace back to the gold ascending triangle breakout zone that I've just pointed out to you on silver, we'd get all the way back down here. And that's all the way down at 3,500, just below. And so look how strong gold is compared to that breakout triangle, miles and miles above it. Whereas silver, compared to its breakout triangle, is just there. We're right there, not too far to go down. So silver has been super weak compared to gold. And there's a chance that we could get down to the swing low. Let's do the two blob thing here too. So baby blob kind of there, like that. And then I think more likely we'll get into the big blob down here, something like that. So that's silver and gold. I hope that's been useful. Don't get too gung-ho on these. It's a messy market. Remember, there's no yield on gold. People are looking for yield. People are looking to buy stuff that's going to produce, profit, either asset appreciation and growth or a yield on the asset they're holding. Like, for example, stock names or whatever, anything that pays you out for holding onto it. And gold doesn't do that. And so don't hold onto your gold when you could be buying something else, and wait for the right time, because gold can tend to get very slumpy and very droopy because of the yield problem. Right, having said all of that, let's look at energies and oil and gas. I think I'll start with natural gas. It's the easiest one. We'll talk about oil after that. So natural gas, I drew this funny little picture. Forgive me if you think it's weird, because it is weird. But basically, I'm long on natural gas. We've talked about this all of last week throughout this whole missile war going on. We've talked about oil and gas every single day. I'm still long on natural gas. If you've been following the progress of this contract, you'll know the whole story. I can't go through the whole thing. It's been higgledy-piggledy, messy galore. But we've got, we had that head and shoulders. We've got this rounded bottom out of support. I don't think natural gas is going much below $3 in general. And I think we'll be trading in the $3 to $5 range. We've got a beautiful rounded bottom with an inserted head and shoulders over here. And then this weird looking thing. We broke down, we crashed down below it and bounced out over here. I added another long position right at the top. I thought we were going to keep moving. Tiny one, 5%. Don't worry about it. It's not going to kill me. Just a little dribble, a little bit there. But look at this pattern. We got this channel that we've held the bottom of. This was late on Friday, and this is a 4-hour chart. Friday bounced up on, late on Friday. Normally, the last move on a Friday is a move down. On this Friday, it was a bounce up. We've had missile strikes on both sides of the oil field. Let me restart. We've had missile strikes on both sides of the natural gas fields contained within and under the sea in the Persian Gulf. But natural gas has not done a lot. Henry Hub price has not done a lot. Different story in Europe. And we came down to the bottom of this, what was sort of I thought was a bear flag, right? It looked like a bear flag. And let's do it like this. Looks like a bear flag forming. And then smashed right back up through the top of the bear flag and closed above it, many candles in a row. We came back into the flag and then closed at the bottom of the flag, bouncing out late on the Friday. But if you apply a weird shaped head and shoulders pattern here, inverse again, left shoulder there, head shoulder here, that could be the right shoulder. And the target for that right shoulder takes us right up to 375, which is my overall target anyway, the green line there. So I don't know. I'm remaining long on natural gas. We have space to add more size if we want to. I think we'll hold here. If we don't hold this right, what I've called a right shoulder, it's nonsense. Let's get rid of it. I just did that for fun. We don't have to call that a head and shoulders, but you can see what looked like a bear flag. So yeah, I think it looks okay. But if we break down from that level there, right down there at about, I'm calling it $3 basically. If we close below $3, I'm expecting we may have to revisit the bottom here, back down into this order block. We haven't double bottomed it just yet. We've held it on both occasions that we've bounced out, tested the top. That's a double bottom at the retest of that support zone down below us. There's a horizontal line there as well. As you can see, it's a rounded bottom with two potential little weird shaped head and shoulders in between. And we've still got some gaps to fill. The bottom of that big weekend gap, which still lingers on, is over here. Everyone may have forgotten about it, but I have not. I'm keeping an eye on this gap all the time. The bottom of this gap is 375, which is a favorite target of mine for natural gas. The top of this gap is at 425, also a favorite target of mine for natural gas. So I'm aiming for either one of those, and either one will do. And right now we're at 312 or thereabouts, are we? 308, something like that. And we'll see how we go. If we break down, I'll hedge and look for us to move back down to the bottom, see if we can double bottom it here just below at about 280, just below $3. I don't think we'll get below there. We might, but I don't think we will. And then try and bounce out of there. But if we hold here, I'll try and add some more size on, more or less where I added the last tiny tranche on to try and shore that one up a little bit. If we break out of here, and then I'll be looking for a move up. I would like to get at least 30, a decent chunk on this one. I've only got sort of half of what I want on this trade, and I think it's going to be a good one. With the oil, with the natural gas fields in the Persian Gulf having been seriously damaged, and it will take 3 to 5 years, they say, to repair the damage. And in that period, there will be less natural gas coming out, liquefied natural gas coming out of there. At the moment, there's almost none because of the blockage of the straits. So all of this puts pressure on the price of natural gas. I'll be very surprised if we gap down this weekend, and despite the weather, and I don't know what the weather's going to look like. We'll look at that after this meeting as usual. And then, but despite the weather, I think we probably will gap up, considering the risk premium that we're going to have to pay for energies coming out and associated with the Gulf. That's natural gas. Now, oil is the same. Bid right up. And we've been now shorting. Don't worry about these positions here. They're all hedged. And that was before the war started. And then we gapped up. When the war began, that was the start, the gap up there. I didn't know the extent of the war, what was going to happen, how it would play out. I tried a couple of very tiny short at the range top. It didn't work out. I immediately hedged the moment we broke up. So a tiny little hedge position there, very tightly hedged. Now we get to where we are currently. And we've reached the 61.8% Fibonacci retracement of the large move up, all the way up to $112.77. We came all the way back down here. And we've now retraced 61.8% and double topped it here on the chart. Let's go to the 4-hour chart. And that's the way it looks. Now, it was looking quite good until Friday, right? And then Friday, everything started going haywire again. We got a big spike up. Look there. I hope you can see it. I'm trying to illustrate this. This is sort of, what day was this? This was Thursday. Late on Thursday, close of play on Thursday. We had a massive spike up through that double top level, collapsed back down again. And then 2 more bearish 4-hour candles leading into Friday. And then Friday's candles started to creep up again. Not dramatically, not violently, but creeping insidiously up again. And that's not good. Unless we triple top this now and then droop back down, depending on what goes on, I have no clue how they're going to resolve the transport of stuff through there. And Iran now seems to be able to reach London with its missiles. Maybe not London, maybe Paris, maybe cities in Spain, Barcelona, or Italy, or Germany. It seems like they can reach there now. And so who knows? I don't know. I don't even know what the price is. I don't really want to look. But if we do move up above here and close above that level, which is at, I'll give you the exact number, basically $100. This is 99.97, right? The top's here, 99.97. If we close above $100, I'll hedge this. It's not the largest position, but it will need to be hedged, and I'll have to see what happens. Maybe we'll go back to the top. Maybe we'll go way beyond the top. Maybe we'll go to $150. Maybe we'll go to $200. Maybe we'll go to $300, or maybe we'll go to $50 or $40 or $30 in the next number of months. I think that's kind of a little bit likely that in time to come we'll be below $50. But for now, and in between that, and it could be weeks, months, or even years that we have a very high oil price. I don't think so. Don't think the US will allow it. But let's see what happens. I'm short. We've double topped here. But when you look at Brent crude, this is WTI. When you look at Brent crude, it's nowhere near as good. And although we have a perfect double top on Brent crude over here, literally perfect, and it may still hold. It's absolutely beautiful. But look what happened once we double topped it. We collapsed back down again. This is a day chart. So that was Thursday. And then Friday, much like WTI, started creeping up again. Not nearly as vigorously as WTI, actually, Notice that we only got sort of halfway back up again because the price is so high already at 107, but WTI crept up quite a lot harder, a lot faster towards that double top that we formed at the 618. So yeah, getting much higher on WTI. So the influence of high oil prices, Brent crude, and around the world, which is slightly damped or dampened on WTI, seems to be that WTI might also, paying a bit of catch up, maybe. I hope not, and getting higher, maybe trying to match roughly the $105 plus of Brent crude and so on. Anyway, we're short, but I will hedge immediately if we have to. Uranium, I've still got longs on, and this drooped down a bit, but I haven't got a massive position on here either. We did take profit on uranium some time back, if you remember. We've started to add back. We got long way down here at about $22. We took a massive profit in this region, right at the top actually, and I've now started to try and buy back at the lower levels into these dips at these order blocks on uranium, drooping down and actually gapping down on the weekend. And of course, not on the weekend, on, Friday. And of course, we know that nuclear facilities were struck in both Israel and in Iran. So I don't think damage, I don't think any nuclear fallout or any dirty clouds are around. We wouldn't know because they wouldn't tell us most probably anyway. But nuclear facilities have been struck, or regions around those nuclear facilities have been struck as warnings. And so we saw the gap down in URA. You think it might be the other way around, actually, but it actually affects demand rather than supply. And lithium, a similar sort of thing, actually, although it just shows lithium did the same sort of thing, probably not related to those strikes on nuclear facilities, actually, battery technology. And folks, I think that's it right now. I've got not much else to say, except for looking at this chart. I want to point this out on Treasuries. This went absolutely haywire. And this is TLT, collapsing on Friday, right there, TLT. And I made some notes. Let me just expand this, make it bigger so you can read. And what you're seeing is TLT collapsing and yields rising. We'll look at the yields chart just now. It means the dollar is strong, the Dixie is strong, the dollar is bid up, but with the rates and inflation fear combined with that, we're seeing Treasuries TLT selling off. So that's the reason for it. It's not good. And the Treasury yields, you can see here the 10-year yield, for example, spiking up dramatically on Friday. So very messy in the Treasuries and bond markets as well. And a little, not a little, a lot of consternation, signs of a little bit of panic going on in the market with massive moves on bonds for a start. Bitcoin has been the solidifier in this whole story. Bitcoin has been doing a superb job holding strong here, dropping off a little bit in the last week, but generally over the last 2 or 3 weeks with this war, Bitcoin has appreciated rather than depreciating, while stocks, etc., as we see in NASDAQ, S&P, gold, silver, everything basically dropping down. Liquidity it feels like liquidity has been drained out of the system completely, except for on Bitcoin. But that's not true, of course, because we know liquidity is heading into the system, but people are rushing into the US dollar and out of all the other stuff as a safe haven play, probably the Swiss franc. Gold, you would think it would have done a bit better, but that was so overblown and overdone, along with silver adding flames to that fire, that these had to correct dramatically, even though there are 10,000 missiles flying around the Middle East. I think 15,000 strikes so far. All right, folks. Now that's it. I've done my bit. I hope I've really covered everything. There's a lot to talk about, and so I've had to talk in slightly general terms about many of these things because there's just too much to talk about. What do I think about Tesla and SpaceX for the TerraFab project? I haven't looked at that, Emil. Let me know about it. I'm not too sure. Put it up in the comments. I'm a Tesla and SpaceX bull, and as soon as I can buy some SpaceX shares, I will do. All right, thanks, Emily. I appreciate that. Post your questions up. I think everyone's done a few. Good afternoon, Sean. Thank you, mate. Appreciate it. Let's go natural gas gap up. Yeah, I think a gap up. I think that might be the most likely scenario. Kiran, you're the savior for most of us. I've been following you since December and recovered 20% of my losses by just being conservative. Thank you, Hitesh. I really appreciate that, mate. Appreciate your comments there. And I'm glad that you recovered. Actually, the reason I don't have to do these live streams and videos, I don't make any money from it. I like it because it feeds into what I do in the live trading group. And I'd encourage you to join there if you haven't joined yet, and most of you haven't. But there's a 14-day trial on right now for a limited period. The links are below this video. And in fact, what I'll do is I'll put a QR code up in the top left-hand side right now for you. And if you click on this QR code in the top left-hand side of your screen right this minute, you can enjoy a 14-day free trial in my private trading group. And you can talk to me all day long, every day, if you'd like to. If these videos aren't enough and you'd like to see more of my ugly mutt, come and join us in the private group. It's free for 14 days. And if you don't want to join after that, if you don't want to carry on, you can just, stop, cancel. And if you'd like to carry on, you can just carry on. I'm pretty sure that if you follow what we do in the group for a month or two, you'll easily recover the costs, I think relatively low costs of joining, and make more money over and above that. It's not a promise and it's not a guarantee, but I think you'll find, like Ritesh just said, that you'll do a lot better in your trading if you get some guidance through the private group. So QR code, top left-hand side, go check that out, and just go and check it out. Up to you. All right, let's get to some more questions. I'm going to try and go through all of them. Folks, I'm basically done. So if you've had enough of me and this stream and the session, you can go now and go and enjoy the rest of your Sunday. But if you'd like to stay, I'm just going to read through some of the questions to say hi to everyone. And right at the end, I'm going to play an outro video in a minute or two from now, and stay and watch the outro video. It's really fun, and it's all about the private group. So if you're deliberating about the private group, watch the exit video. Did I say intro? I meant outro video. Let's go natural gas. Yes. So thank you there, Hitesh. I appreciate what you just said very, very much, and I hope others benefit from it too. Good day, Roland. Lovely to see you, mate. Happy Sunday. All right. Trump is not in a good position, and he knows it. Yeah. Supply issues, even if the war ends, do you think natural gas price will remain elevated? I think natural gas will trade between $3 and $5 in general. Natural gas is a range market, so don't be a natural gas bull or a natural gas bear. I'm neither. I expect it to be bid up at around $3 or just below, and I expect it to sell off at $5 or just above. So that's the story. And I think that we've moved into a slightly higher range because of war, because of AI and data farm demand and general electricity demand. And natural gases are good. Great hair. Thank you. Thank you. This too shall pass. I haven't seen you for a very long time. And in fact, probably the last time you saw me on stream, I had pretty long hair, shoulder length, and now it's short. So I did that actually for a reason. I got a job, well, I did some contract work for Olive Prime, and I thought it would be nice if I showed up with a short, trimmed, what I call college cut hairstyle. No, don't worry about that. This too shall pass. That was just the Nightbot. Ignore that. It's just a robot. BTC 30K could be, yeah. Yeah. I didn't call you that. This too shall pass. That was the Nightbot robot. Yeah. It can be a little harsh, can't it? I mean, what the hell, man? Why is Nightbot talking to my clients like that? Unbelievable. All right. Let's get through some of the questions before we finish off. Hey, Vishesh. Emily was told off as well. Damajan, you are late, mate. Don't be late. Be great. Hello, Sean. Puppies are pet. Do you want to see the puppies? Anyone want to see them? I don't know who's still here. Anyone still watching? If you want to see the doggies, I'll bring them up. I'll show you. Hey, Hitesh. Abby, I trade with Black Bull Markets. There's a link below as well in the description. You can check out my broker. If you sign up with Black Bull, they're my favorite broker. I use a couple of brokers, but my main broker, Black Bull Markets. And if you sign up with them and open an account, they will give me a little bit of commission. It won't cost you anything, but I'll make a little bit of commission from that. So it's up to you. Anyway, folks, I think that's everything for now. I hope you have a wonderful trading week. It's going to be really tough and really difficult, particularly with energies and metals. So, and stocks as well. Stocks are pretty simple though, because we know the levels. We're right at them at the moment. We don't hold here and we break down below. Let's have a look at the chart quickly while I'm talking. We don't hold here on stocks, right? these levels on NASDAQ and S&P. You can see what they look like. Then we're going to get hedged. So that's pretty simple, not difficult. I'm already hedged on the German 30. As you can see, that's already broken down. Not surprisingly, of course, look how big that broke. So those are pretty easy. But when it comes to, and Bitcoin's pretty simple as well, I think, and cryptos, not too bad. But when it comes to metals and this war and the levels that we're at, and we could see these metals go crazy, upwards or downwards, sideways. I don't know. I just don't know. I'm very wary about all of these, gold, silver, and copper particularly. I'm not trading platinum. And then also energies. Be very, very careful. I'm not going to hold on to these shorts on Brent crude, or I'm not trading Brent on WTI. I'm not going to hold on to them if this starts moving higher. That's just not going to do it. I don't know how much higher it will move. I don't think a whole lot. I honestly don't. I don't think we're going to hold above $100, if at all. But if we do, not for very long. That's what I think. But when things go wrong in wars of this nature and this scale, and maybe it's even the unmentionable WW, I'll say it in Arabic, so I don't have to use the word in English, talata. If you're Arabic, you know what talata means, WW talata. If we're heading in that direction, then it doesn't really matter what else goes on, because we're all in big trouble. So let's hope there's nothing worse than what's currently going on, and that it winds down quickly and efficiently, that there are happier people in the region, and that oil and gas and fertilizer and Vaseline jelly and all that stuff keeps flowing out of that area, because all of this stuff is made by petroleum products, and we haven't got any of it at the moment. So be very, very careful, not just with oil and natural gas and metals, but of course the stock markets. As I said, these are quite simple. If we start breaking down and we move down dramatically, I'll hedge the whole lot, no hesitation whatsoever. Same on gold and silver. If we move down, I'll hedge those. And the same on stocks, actually. We talk about stocks, but metals might be very choppy, very whipsawy. And these are the ones that worry me most, metals and energies. And we're just going to be trading small. Keep your sizes small. Trade gingerly, and make sure that you stop your trades out very, very quickly, or hedge them as soon as the market moves against you, because the markets can carry on for 1%, 5%, 10% before you even have a chance to look back and say, hey, I should have done that, or I should have done this. So be very, very careful. And that's my advice from an old Jampa talking to all of you. All right, folks. Well, I'm not going to show you the dogs. I'll show you them in video tomorrow. I'm going to play my outro, and I'll see you in video tomorrow. Make sure to tune in. Make sure to subscribe. I put a video up every single day. So if you want to make sure you don't miss them, subscribe to the channel, press the notification bell, the thing that looks like a bell, and also consider joining the private group. It's free, 14 days, 2 weeks. It's a long time. And if you'll find out whether you like it or not, or whether it's beneficial to you. There's plenty of time to find out, and it's completely free. So just go and do it. Speak later. Ciao. Hi there, I'm James. I'm the founder of ArcisFX. I'd like to personally invite you to join our 24/7 trading group. This is built for traders who want an edge. Inside, you'll get access to live calls on Forex, commodities, crypto, energies, and metals, along with exclusive daily analysis designed to unlock your trading potential. And this in both traditional and now in digital markets. I'm talking Bitcoin, crypto, altcoins, and tethered currencies. You'll gain early access to insider news, real-time updates, real-time support, and premium educational content. If you want to sharpen your skills and boost your success rate, then join me and Paul in this community. This is a fast-growing community of traders who are now writing their own success stories. So don't wait. Join up now. Your edge starts right here.